So today, we traditionally talk about MSPs, but we want to keep this more general around the forecasting for professional service businesses. And I really want to focus in on this year specifically. Many clients are looking at what is the recipe for growth? What is the recipe for building a plan on what they can reasonably hit this year, including how do we raise prices? Where do we need a price? What is a reasonable growth rate? Are our margins right? Do we need to cut costs? When you start this process of building a forecast with your clients, Matt, where does that conversation lead when they're throwing all this information? They have all these concerns, they have all these considerations. How do you take that and say, okay, let's start where we build this into a plan? Where does that really begin?
Mm-hmm. I typically start on the top line, so on what will the sales target be, because that really will gauge a lot of the investment decisions that are needed throughout the year. So if there's a client and they're looking for a pretty, I'd say reasonable growth, say 3 to 5%, that's one set of actions that you take. But then if there's another client that they want 10, 20% growth, totally different story altogether. So knowing that up front is very important. And once you set that top line projections, then it's funneling down to, okay, what type of return or profitability would you want if you hit that sales line? And so it goes top to bottom, and then what do you need to get in terms of that middle portion of your P&L, so your cost of goods sold, expenses, in order to hit that final profitability. But to answer your question, is that sales target that we want to decide on at the very start.
Yeah, I know last time we talked about budgeting, you said, hey, it all starts with the security of sales and how much can we trust this revenue, how much can we determine, because that's really where everything flows from. Now, when you talk about linking this of saying, hey, how do I link that sales to the operational data? Hey, we have this million, 2 million, 5 million in top line revenue and sales. How do you link that to the operations really, to say, hey, are operations running smooth? Is this revenue secure? Is this revenue really profitable? Where does that conversation start? Because that's one of the number one questions that I get, at least.
Yeah, so in terms of security on the revenue line, it's going to come down to your mostly reoccurring revenue, because that's going to be most secure. So what are those monthly invoices that you get out to clients that are consistent? So you have an engagement set up, you might have a 1 to 2 year term, whatever the case might be, but that monthly amount, that would be your most secure. So let's say you're looking at last year and you want to do a certain percentage of growth versus the prior year, but last year was a really heavy impact of project work that wasn't typical. You had 1 or 2 very big projects. Well, now it's very difficult to achieve that growth versus last year, because that project revenue won't necessarily be repeated. Think of projects as, I think of it as trench warfare. So you win a project and you do well on it, it might be very profitable, but then you got to win that project with someone else again. There's nothing that'll reoccur in that, where that monthly reoccurring revenue is typically secure. You want to make sure your churn isn't getting too high, but it's more stable.
Now, I know a lot of, especially managed providers, whether it's the agencies, the consultants, the MSPs, they use these projects to drive that MRR. Do you have a ratio, or do you have any examples of clients that are MSPs that you've worked with where you've said, hey, you should target this amount of project revenue because it turns into typically this amount of MRR and ARR?
I like to think about it in a different sense. I like to think about it as you want your reoccurring revenue to help fund your business. Meaning, if you take all your reoccurring revenue, take the profit that you gain from that reoccurring revenue, could you fund your overhead of the entire business? And if you can, then all your project work and the profit you get from that is considered a bonus. So if you can think about it in terms of, hey, that reoccurring revenue, that's the lifeline or the bloodline of the business. And then you're not so desperate in trying to win that project work. Now, you might take projects from a new client that you hope to grow into reoccurring revenue, and you want to be able to track that conversion. But I think about it as you want to really focus on that reoccurring revenue. And then you can, with those customers, try to drive additional revenue growth by looking at what additional projects they might want to do with you.
Yeah, I think that makes sense. And I know there's a lot of MSPs that are now entering this market with a weird, I have project revenue, but it's actually an MRR or at least an ARR type of project because I'm doing it every year, whether it's a HIPAA compliance audit that they do or a lot of the CMMC, the government defense. And one of the biggest ones I'm seeing now is they're doing more of truly a half year, a mid-year engagement where they're going in and assessing and building projects and having sometimes minimum spend retainers. I've seen that in the MSP space. And I think anything, for at least my definition is if it's recurring, if it's contracted, and there's a period of time where you can expect it more than a one-time payment, I would consider that recurring revenue. But how do you help these clients and the MSPs or these agencies that say, no, we manage an Airtable or we manage some database that we do an overhaul every year on? How do they look at that, or how should they plan that into their forecast if it's, say, a large lump sum 2 or 3 times a year that they can always expect?
Yeah, you're exactly right. If there is a contract tied to it and they know it will reoccur, then that for sure can be considered as reoccurring revenue. One thing that we're seeing a trend on is movement to, instead of having that lump sum one-time payment with those customers, try to get them on an annual plan where they might still pay you the same amount, but they're paying you every month. So you have that consistent cash flow. You don't just have that one big lump sum that comes in. If you can convert clients to that method, again, it helps cash flow. You don't have that uncertainty. And you also don't have that worry of, well, what if they don't renew that project? Yeah. Well, they're paying throughout the year. So they're already paying for it in little bites, 12 monthly installments throughout the year. It's easier for them to plan for that cash flow as well. So there's benefits to both sides, and try to move to that invoicing arrangement. And it makes it easier to forecast as well.
Absolutely. And I think there's situations where sometimes it's unavoidable. Maybe you're winning contracts from Microsoft, or you have a large, AWS or a Cisco integration, and you win those because you have a large client that has entities in 40 different locations. And I think when you look at that, how do you build, hey, no, I'm an MSP. I know my MRR is, going to be at least 70%, 80% of my overhead. I rely on these projects to make the difference. How do they build that project management or that project profitability? Because, what I see is, hey, it is a $200,000 project. Now you could still spend 60 or you could spend 90,000 to deliver that project. How do you help clients on, let's say, whether it's that 13-week cycle, or how do you help them manage that into their annual plan and say, hey, I know every April and December or April, November I'm doing this. How do they build that if it's, hey, I just get that lump sum? What can they do to manage that on a forecasting basis?
Yeah, if it's huge projects that are reoccurring every single year, being able to use the past to help guide in terms of how much resources do we use for that project, in terms of, it might be people's time, other materials that were used for that. Use that as a baseline and ensure that the people that are working on the project understand that each individual project has its own budget. So when we talked about a budget earlier, we're talking more total company, but a project can have its own budget as well, meaning, hey, for this particular budget, using that $200,000 example, we have budgeted X amount of personnel time. We have budgeted out X amount of, maybe there's some contractor work that we need to outsource as well. We have put that in. So we have a pretty good estimate going into the project what the profitability will be. It's tracked throughout so that if we're getting way too offside, we're able to know about it. And if it turns out there's some scope creep to that project, we're able to notify the client ahead of time to be able to say, hey, we took some additional, we're being asked to do these activities out of scope. We need to therefore charge additionally for that to help maintain the profitability for that project.
Absolutely. And I think when you look at one of the major areas of forecasting, which leads to my next question, how do you support really protecting gross margin? You're forecasting, I'm sure, throughout the year, hey, we can anticipate a 50 to 55% gross margin. How do you really protect that with a monthly forecast and using a forecasting as really a tool to guide that operational labor spend?
Yeah, the biggest thing in terms of gross margin is, do you allocate labor to cost of goods sold? So what's that labor associated to your service delivery, and is that being allocated to cost of goods sold, which is the key component to gross margin? And to do that, there's a varying scale of what is best in class, which would be you have a time tracking system where everyone is expected to, record their time. So, those activities that related to service delivery, those things get allocated to COGS every month. And you want to be working with your bookkeeping team in order to do that, where I would say just the, learning to walk before you run, that would be, hey, each person has a estimated amount of time that they spend on service delivery. So we might do a 50-50% split where 50% of that person's labor is put to cost of goods sold, and the other 50% is considered more admin or overhead, and do it that way. That would be probably the entry level in terms of doing this correctly. But the key thing would be, as you're more mature as a company, using that time, like having a time tracking system and having your financials reflect where your people are spending the time.
Yeah. And when you look at that, it always leads into, hey, I don't know what my gross margin is because I'm not allocating my labor, which then if I'm not allocating my labor to that revenue, it's going to be really hard to know, is that labor unit profitable from a utilization rate? And this is going to lead really to my next question is, how do you help these professional services, we'll stay MSP specific there, how do you help them calculate, hey, this hire is a profitable hire for you? Or how do you help them get to that utilization rate as a part of their forecast? Let's say I'm a $2.5 or $3 million a year MSP. I have 3 or 4 technicians. One of them is $65,000. My highest is $100,000. How would you go about really helping them build out their forecast to make sure that, hey, the $65,000 technician is just as profitable as the 105, or vice versa, the 105, which is my highest paid, should be my highest profit? How do you implement factors like that into, say, that forecast?
Well, this is getting back to ensuring that the time tracking system is accurate. People are filling it out. People understand why you're doing it. And often what the key thing is in communicating to the employees is that we're not doing this in order to be big brother, to look over your shoulder. We're doing this to make better decisions for the business. So, a great example is, that engineer that not only does project work, but also helps the help desk as well. And is too much of their time being quote unquote stolen by the help desk trying to deal with current client issues that they're not doing that billable work on projects that you really want them to, and constantly checking that utilization of, hey, maybe our goal is 80% for a certain employee. If that person is falling consistently short, why is that? And then you might find the root cause is, well, the help desk is just, they're getting too many particular support tickets. Those tickets run through this one particular person, and then you can figure out, okay, we want to solve that one issue to help free up that person's time so they're more on the billable project work that is really profitable.
Absolutely. And I think that's where you see it in that traditional sense where the MSP, oh, it's clear I have the senior technician, but the other caveat that you do see in these $2 to $5 million a year and up MSPs are the ownership. How much of leadership is owning these projects, owning clients, a part of there, and what would their billable rate be? Because what I often see is, no, this project's pretty profitable, but you have ownership that's feeling, I don't feel like I'm making enough. I don't feel like there's enough. My effort's there. I can't focus on growing, which you're doing this conversation. You're having this conversation around forecasting because you want actionable, targeted, and measurable growth. So if you're stuck in that cycle of, I'm the business owner and I'm doing billable work, if you're not, one, billing for it, that's truly, really, you're going to see a huge profit loss there. But then when you take that next step to say, I'm not even tracking where my time is as an owner, because there are instances where the MSP, the owner should be the highest 400, 450 an hour, senior VC, so expertise around whatever billable rate to own and manage certain projects. But that should be accounted for in a percentage of their time. It shouldn't just be this, well, they kind of help in and out, because that not only does a disservice to the business, but it does a disservice to the technicians too if you're never pushing that work down and never really, letting people be at their highest and best use. I know this is, we've talked really into the detail around some of these specific metrics, but I want to get into really the cycles and what this looks like, because when you build a forecast, one, it's going to be very hard not to focus just on revenue and how big is that, what's the sale, what's the profitability, when really what I hear and what we're big preachers of is that 13-week cycle. Instead of thinking of this business on a month-to-month basis, looking into those 4 blocks of 13 weeks and taking more of a cash flow perspective. Profit's great, revenue's great, gross margins were great, but you need to take the forecast as opposed to budget from truly a cash flow perspective. Can you help describe really why that is, why cash flow forecasting and that focus is so important when building a forecast, as opposed to spending the time focusing really on revenue, profitability, and all the fun, cool financial metrics?
Well, the number one thing when we're talking about, forecasting for aggressive growth is how are you going to fund that growth? Can you afford to do it internally or not, or do you need some outside funding in order to have it injected in the business to fund that growth? So when we talk about being able to grow aggressively and thinking about cash flow, it's how quick is that cash conversion cycle? Some businesses are a lot faster than others. If you're giving 30-day terms, 45, even 60-day terms, and you might be growing at a pace where you need additional financing, either through a line of credit for some of that short-term financing or some additional investment from your current investors in order to fund that growth. So if you're not trying to forecast cash flow, you could be easily caught in a bind where you might be being really successful, but you're just growing so quickly that you might be cash strapped for a certain period of time. So that's where forecasting, having that focus on cash flow, that's going to be your number one metric that you always need to be in top of mind.
Got it. I want to get into really detailed, even you can riff here, we don't, the professionalism, all that. What are the things, when we look at you're building a forecast, where are you keying as Matt Kerrigan for your MSP clients, saying, here's where you need to really be focusing for aggressive growth, here's what matters, here's the numbers you should key on? Because you build a forecast, there's tons of information, there's lots of revenue lines and expenses in here. Where do you direct them to say, hey, here's the highest key, top 3 or 4 areas you should be focusing on this forecast on a monthly basis to lead your decision making?
Well, the number one tends to be your labor utilization in terms of what capacity that you have. It's all well and good to have a really a strong growth plan, 10, 20% revenue growth. But if you don't have the resources to support that growth, it's not worth the paper that's written on. So it comes down to, if you think about, sticking to the MSP example of if that growth is going to be tied to reoccurring revenue, well, how many clients can you onboard at one time? Is it 1? Is it 2? Is it 3? So that once you know that number, then it's like, okay, what's the average deal size? Well, the average deal size based on the market that we target is X. Okay, now we know every month, let's say your reoccurring engagements, let's say they're 5,000 a month and we can onboard 2 clients at once. Well, I just know now my capacity is I can do 10,000 of new MRR every month. I can do that easily. If your plan says 15,000 or an additional one, now you're going to have some troubles because you have too many new clients than what your onboarding is able to take on at one time. So you either need more resources in onboarding or you need to cut back on that forecast. So labor is always going to be that number one key. And then people now with AI thinking about, hey, as I grow, I want to try to keep headcount as stable as possible. What can I offload on the AI front that can help me with this as well? So it's not necessarily trying to replace people, but it's trying to ensure that I'm not growing my headcount costs at the same rate I'm growing my sales costs, so that I can get see some margin improvement over time as my sales grow.
Yeah, I think you hit the nail on the head right there, because when you look at it, onboarding capacity, service capacity, utilization capacity, the first inclination in nature is to go where? Do I have enough people? Do I have enough hours to throw at the problem? But sometimes it's, is that labor efficient? Can that labor be efficient? Are the processes, systems, and tools that I use to service that onboarding labor and such, is that limiting my team from being able to take that next step? That's something we do every day here at Strive with accounting, tax, finance, procurement, different functions in the business. And for the MSPs, you have to look and say internally, you're doing that for your clients. You're saying, no, if you use this service or this cloud base, it's going to save this amount of time and be blah, blah, blah. do the same for your business. And I think forecasting is going to give you clarity. It lets you say, where can I deploy? You know what? We would love to work with an Autotask or a 𝐒𝐿O consultant and spend 3 or 4 months figuring and fixing some things up to improve our team, but we need to deploy $2,000 or $3,000 a month in a consulting time. Well, having that forecast and being able to take an action, those are the questions that you can answer using that forecast. Now, Matt, how often should business owners, leadership be looking at their forecast? Monthly, daily, weekly? What is a good cadence to, be reminded and to use it in their structure for decision making? What does that look like?
So you want to be looking at it at least monthly, but I would say that you want to be in a mindset of I'm always forecasting. And what that means is as I get new information that changes from what I had before, it needs to go in the forecast. So if you have a current client and you're able to upsell them an additional package, you want to have a process in place where, boom, the forecast gets updated right away. You have a client that informs you they're offboarding. You want to also update the forecast right away. When clients get stuck in that standpoint of, well, I'll update the forecast in a couple of months or whatever, I'll worry about it then they can fall behind in terms of having that real-time look at what their profitability will be. Because for some clients, it only takes 2 or 3 customers to leave where they might have to make some tough decisions, and they want to always want to ensure that you're on top of that. So when I say always forecasting, it's, hey, something in my environment has changed. I need to make sure that forecast is updated.
Absolutely. And I think we often get the question, and how important is for this, similar to beyond the budgeting of the spreadsheet, how important is this to be somewhere where it's accessible, it's a living, breathing document, as opposed to we build this once and we just update a spreadsheet? Do you usually say, hey, build a dashboard, build some sort of reporting? Where do you find that when this becomes ingrained in the culture of decision making, hey, we're looking at this once a week as a leadership team or twice a month? Where do you find that makes it easy? Because what I want to hear here is for the MSPs and companies is, yeah, it's great to have it, but how do I embed that into a process and make it a habit to really forecast on a monthly or a weekly basis?
Yeah, great question. The easiest way to embed it is you make everyone's goals within the organization ends up getting tied to that budget that we talked about earlier. So the budget and the forecast, they're different, but they're parallel in sense of they're trying to predict the future in terms of your financial performance. But then when you think about all the employees' goals, they should all link back to that original budget, and that's what everyone's shooting for. So to get that culture where people want to know where are we against the budget, well, they know, hey, I have some incentive comp that's tied to me meeting my goals and also for the company to hit their goals. So I'm going to want to know that update. And so when it comes to that weekly leadership call, they're going to know, hey, are we on track? I understand one of our bigger clients have left. Where are we in terms of will we still be able to hit the budget? Hey, I understand we're having a little bit of difficulty onboarding. Where will that hurt us in terms of that new sales that we have projected for the year? So when you tie people and you get their buy-in from that standpoint, it's a lot easier for that culture to really feed through, and people will thirst for those updates.
Yeah, it comes down to the gamify your business, build the scoreboard, let them see the progress of where we're going, and compensation's great, and I think compensation, it's also comes down to, hey, if I want this tool, I want this, let's say an assistant, or I need this and it costs X amount of dollars, if we can own this profitability, we can get that, and building just that cycle, and it becomes a positive feedback loop. Now, we're getting close to time here. We've covered a lot today. We've covered why cash flow is important, the difference between budgeting and forecasting, the actions around hiring, gross margin, protecting sales, profitability, cash flow, and so on. But that's a lot. Let's say too long, didn't watch, too long, didn't read. Matt Kerrigan, what's the 1 minute that an MSP can say, hey, forecasting, actions for aggressive growth, what's the one takeaway they can take today and use in their business?
The number one thing is, that cash flow is going to be king. So if you're looking to fund aggressive growth, it's going to be, hey, am I able to generate enough cash internally in order to fund that growth, or do I need other outside resources in order to fund it? Either it be through getting a loan from the bank or potentially getting additional investment from current investors that we can fund that growth. Because without being able to fund the growth, you can do a fancy budget or forecast, and it's not worth anything because you're not going to have the cash to fund it, and you'll find very shortly that, hey, we're just not able to do this, and you'll scrap it right away.
Absolutely. I think got to build something that becomes habitual. You use it, becomes a tool, just like your PSA, just like anything else, AI automation. The tools only work if you use them and consistently reevaluate, improve on them, and embed them in your organization. Matt, once again, thank you again for taking the time today. I know you're busy this time of year especially, so thank you once again for joining us today. This episode will be available on our LinkedIn, YouTube, and Stride.services.
Thanks, Casey.
Thank you.